Marc Ostwald is the Chief Economist and Global Strategist at ADM Investor Services International. Great to see you again, Marc. So, is this a set of numbers that should reassure investors?
It's a mixed bag. The primary drag, actually, on GDP was the rise in energy prices. For the first time since the first quarter of 2023, deflation is no longer an issue. The deflator came in at 1.6%, but in real terms, obviously, that's a drag on GDP. The monthly indicators, it's good to see retail spending back in positive territory, but it's still actually quite far below that stated target of about 3.7% per year as outlined in the 5-year plan. Industry is still a massive strength, as is external demand, particularly autos and anything AI related. So there are still imbalances in the economy, and above all, the property sector continues to weigh very, very heavily. Property investment down 18.7%. That's the worst contraction in this 4-year cycle we've had of a drag on GDP from the property sector. And something basically, as much as you don't want to see people going crazily into the property sector, given the demographics that there are in China, you also don't want the big debts that there are in the sector to be weighing on the economy, because that basically clogs up bank balance sheets when they could be lending to many other sectors if they weren't encumbered by those property debts.
So a lot of this is reflected in the global backdrop as well as challenges at home. But, China's growth model here clearly evolving. Are we seeing a sustainable, higher quality expansion taking shape, or is the economy still too reliant on exports, on industrial strength?
It is too reliant on external demand, but on the other hand, when I look at the external demand, it's not really surprising that I've expected to see that continue in the second half of the year, because China makes a lot of things that people need for the tech sector, for the energy transition. Above all, auto sales, auto exports are skyrocketing because so many of the other automakers aren't competitive. But what definitely needs to be done is something to stimulate personal consumption. And it needs to be done probably in a much more forceful way. Social transfers, as outlined in increase in social transfers, as outlined in the 5-year plan, would certainly help. But what really needs to be there, which was evident in the loan data today, is more confidence from consumers and businesses to borrow. And at the moment, that's simply not there.
Just very quickly, Marc, I think I know what you're going to say here, confidence, consumer confidence, but what will change the market conversation on China from here? What signals are investors watching in the months ahead?
I think they will be looking at what exactly the details of what sort of stimulus to get the grey economy going, get improved childcare are going to be, and whether they see those as getting long-term traction.
Marc Ostwald, great to speak to you again. Thank you so much.